Are you a Forex trader trying to understand leverage and how to use it in Forex trading? Leverage can be a powerful ally or a formidable foe, depending on how it's used. In this video, we'll explore the question, how much leverage is too much in Forex trading? Stay tuned as we reveal the secrets to finding the right balance between risk and reward. Remember to watch the entire video. We also have several videos on the channel that we know you will surely enjoy. So watch them after watching this video. For everything else, free Forex courses, free Forex robots, free indicators, and the broker that I use personally, see the links in the description box below. Before we dive into the ideal leverage, let's understand what it means. Leverage is a tool provided by brokers that enables traders to control larger positions with a smaller amount of their own capital. For example, a leverage of 1:100 means you can control $100 with just $1 of your own money. This amplifies both profits and losses. Leverage is a double-edged sword. When trades go in your favor, it can lead to impressive gains, but when they don't, losses can be devastating. So, how do you find the right balance? Every trader is different. Assessing your risk tolerance is crucial in determining the appropriate leverage. Experienced traders with higher risk tolerance might handle more leverage, while beginners should proceed cautiously. As a general rule, starting with a leverage of 1:10 or 1:20 is considered safer. In fact, in the United States, it rarely goes beyond 1:200. This allows you to control positions that are 10 or 20 or 200 times your initial capital. It's a prudent approach that lets you manage risk effectively. However, outside of the United States, Forex leverage can go as high as 1:2000. Yes, I have a broker that offers leverage of 1:2000. My broker now offers 1:1000. You can sign up with the link in the description box below. Of course, using a leverage of 1:500 or 1:200 might seem attractive for potentially sky-high profits. Yes, it is profitable to use high Forex leverage if the Forex trader has a good Forex trading strategy and knows what they are doing. However, for most traders, this can be too much Forex. High leverage significantly increases the risk of losing your entire trading account. High leverage can also tempt traders into overtrading. Taking on too many positions in search of quick profits can lead to emotional trading and impulsive decisions, ultimately resulting in losses. To ensure you use leverage responsibly, always have a risk management plan in place. Set stop loss and take profit levels to minimize potential losses. Discipline and planning are the keys to success in Forex trading. Remember, finding the right leverage in Forex trading is about striking a balance between risk and reward. Stick to a leverage that aligns with your risk tolerance and trading strategy. If you found this video helpful, give it a thumbs up and subscribe for more valuable content. Happy trading!